What's going on? What's going on, YouTube? How's everybody doing tonight? I hope everybody's doing good. We're gonna get started here in a couple of minutes. I'm just gonna wait for some more viewers to pile in before we actually get started. Can everyone hear me okay? I hope my mic is all right. Let's get this over here. Let's see, can I bring this any higher? Oh. Let's see, that starts to kind of get in the way, doesn't it? Oh no, we could bring it a little higher. Okay. There we go. There we go. Oh man. All right. Just got to get a couple of things squared away here. It's been a while since I've done a live stream on YouTube, and there's actually a good reason for that. The last time I did a live stream, I think I got banned from streaming for 3 months for actually looking at a clip of The Wolf of Wall Street on my stream. So let's not do that again. Let's not get banned from live streaming for 3 months. That sucked. All right, we're almost at about 3 minutes into the stream. I'm going to go ahead and get started here. So if you're new to my channel, then I'd like to introduce myself. I'm Crypto Clay. I've been on YouTube for some years now. However, I recently just came back after a pretty long break of not making any videos or live streams, but I felt like now is the perfect time to come back and maybe present some of the knowledge that I've gained in the time that I've been away, along with, coming back during this COVID-19 pandemic to talk to you guys about some things that are going on right now with the economy, the global economy, the US economy, and, on top of all that, cryptocurrencies as a whole. That's mainly what I like to talk about on a day-to-day basis, but there's so much more that gets involved whenever you start talking about this pandemic and how it's affecting every type of economy right now. So we're going to go ahead and talk about a lot of those things tonight, and I hope you guys stay tuned throughout the entire live stream, because there is so much to cover. There's so much that I would like to discuss with you guys, and I hope to get some feedback from some of you. I'm not really sure who all is watching right now. Hopefully I've got some of my viewers that have been around for a while that can talk about some of the things that we've discussed before in the past that kind of coincide with what's happening right now in the economy. But if not, I would love to hear from any new viewers that might be in the audience tonight. But let's go ahead and get started with a couple of things. The first thing that I wanted to discuss tonight that has to do with what's going on right now in the world, and it's actually affecting us more than you guys might know, and that is the purchasing power of the US dollar. The purchasing power of the US dollar has continually gone down since the Federal Reserve has been created. The Federal Reserve came about in 1913 and is essentially a national banking system that we use to delegate what interest rates are going to be and also to allow us to print money. That is what the Federal Reserve is here for. That is a very basic way of describing what the Federal Reserve is. It's actually a lot more complex than that, and I highly encourage you guys to read up on exactly what the Federal Reserve is. But ever since the Federal Reserve was placed into existence by the federal government, the price of the dollar has just dramatically dropped. And you can see here, over here, the value of a US dollar went up in the roaring 20s. So throughout the roaring 20s, we saw the value of the dollar go back up because the economy was in very great standing during that time. We had a booming economy. We had many of our working class out spending money on goods and services, and then the Great Depression hit us. And during that time, the value of the US dollar obviously started dropping because our economy as a whole just went dramatically down. Our economy was in a worse spot than we had ever seen up into that point. And the Great Depression is still known as one of the worst economic collapses in history. So there was a lot going on during that time, and there's so much to talk about with the Great Depression that it's just too much to unpack right now at this time. I want to continue pressing on and talking about the US dollar itself. Another very important point in our history, in our nation's history, was when President Nixon decided to take us off of the gold standard. So before 1971, every single US dollar was backed by gold. We were on the gold standard, and we had gold stacked on gold at Fort Knox. And in 1971, President Nixon decided to take us off of that gold standard. So no longer was the US dollar backed by gold. It was backed on the economy. And the influence of our economy is what drove the price of the US dollar. It was also around that time that we started doing dealings in OPEC, and the US dollar became pegged to OPEC. And a lot of people still call the US dollar the OPEC dollar to this day. Essentially, what our dollar is propped up on are the sales of crude oil. If we were to lose that trading agreement with pegging the US dollar to oil, then our economy would basically deflate overnight. And we're starting to see where China is trying to get more and more purchases of oil on the Chinese yuan. And when that happens, the US dollar is going to plummet in value, if that ever happens. And I could definitely see that happening in our lifetime. The Chinese government is doing everything in its power to disrupt our economy and bolster its own. And we're trying to do the same thing as well to them. But if you look in 1971, whenever we took ourselves off of the gold standard, the price has just increasingly gone down. This chart only shows to 2013, but the price of the US dollar is lower than this 5 cents right here. So back in 1913, when the Federal Reserve was created, the value of a dollar was actually $1. The value of the US dollar is now less than 5 cents. So the value of that $1 US that you would have had back in 1913 is now worth less than a nickel. And that says something about our economy. Yes, we have had a booming economy. We've had a thriving economy up until this pandemic. And you can see that in many ways. One of the ways that you could say that our economy has been thriving is the stock market. However, at this point now, we can't really use that as a gauge because the Federal Reserve has decided to take it upon itself to prop up our stock market during these troubling times to make sure that it can't fail. And I have a very big problem with that, and we'll talk about that more later on in this live stream. But the Federal Reserve is doing everything in its power to make sure that our stock market does not fall out of the bottom. So again, this is one way of looking at how the US dollar has gone down in value over time. But another way is to look at our real estate market. Now, anytime you talk about real estate, the value of a property is based not on the physical building that it's located on, but on the land that that building sits on. So when we're talking about property value, we're talking about that specific plot of land that you get sold the deed to whenever you purchase that piece of property. And if you look throughout history over the past 20 or so years, you can see that the value of property has just continually gone up. And you have to ask yourself, is this property really going up in value? Well, I have an idea that the property values should never really go up that drastically. It's just the fact that our US dollar continues to go down that property values appear to go up. This is actually my first home that I ever purchased, and this is just one example of how I can prove to you guys that values of things are not where they should be. I bought my first home in Bellevue, Nebraska for $136,000. Now, this home is nothing special. It's a 3-bedroom, 2-bath home, 1,400 square feet, not at all anything special. It's just a basic starter home that anyone would enjoy. But I bought it in 2013 for $136,000. I sold that home in 2017 for $170,000. And when I go on Zillow now, it's listing that home value at $191,000. And they get that number based on the sales of other homes in that neighborhood. So looking at that, you have to ask yourself, did the value of this home, which I hardly did anything to that home after I bought it in 2013, I installed a fence, I did some things inside with lighting and the cabinets, but nothing that should have gone well above the price that I paid for that home. You have to ask yourself, over 7 years, how did the price of this home go from $136,000 to $191,000. Based on standard metrics, that should never happen, but the market is being inflated. And the market is being inflated because the US dollar is being inflated. And the value of that US dollar is going down, so it appears that all property values are going up as well, when they're not at all. That property is the same property that I bought back in 2013, so why is it so much more expensive now? We're starting to see a lot of things that were similar to the 2008 housing market collapse. During that time, we saw the value of homes just continuously going up, and people going out and getting as many loans as they could to purchase up these homes that were going up in value. And the banks weren't even checking to see if these people could pay back those loans. If you haven't watched The Big Short before, the movie, I highly encourage you to look at that movie. It's a great, great movie with Christian Bale, and it talks all about what happened during the 2008 housing market collapse. Now, obviously, it's a Hollywood production, so it's not going to give you all of the facts and all of the details. You can look that up on your own, but The Big Short does a really good job of describing what it was in simple terms that occurred during the housing market collapse. But my point that I'm trying to make is that we're starting to see a lot of similarities from what occurred back then to what's occurring now. Back then, we were trying to bolster the market by fabricating these loans that banks knew couldn't be paid back by the customers that they were loaning out to. And then they were going on the secondary market and selling those loans to investors, thinking that these were good loans, when in all actuality, the bank was lending out very shady loans and labeling them as good loans. So that's my first point that I wanted to make. The value of the US dollar is going down. The next thing that I wanted to talk about was actually an article that I read on Market Watch talking about Kyle Bass. Kyle Bass was actually one of the gentlemen in the 2008 housing market collapse that bet against the US housing market. People thought he was crazy. People thought he was insane because he took a bet against all of the banks that were loaning out money to individuals to purchase homes. Kyle Bass is a brilliant investor, and he made a call that made him a very wealthy man, but he was actually very sad whenever he took that bet because he knew exactly what he was betting against. He was betting against the housing market as a whole. So by betting against the housing market, he knew that people were going to lose their homes and their jobs, and many people were going to go bankrupt. But he still took that bet because he knew that it was going to happen either way. So he bet against the housing market, and it did eventually collapse. Well, Kyle Bass is now making more predictions, and that prediction that he made back in 2008 was a very wise one. So if he has something to say about the current economy, I'm definitely going to listen to some of his advice. So on Market Watch today, Kyle Bass was talking about the current status of the economy. Let's just go ahead and take a look. For the year, I think you're going to see the US GDP down somewhere between 7 to 10% in real terms. As a result of the COVID-19 pandemic and the government's efforts to contain the spread of the virus with business shutdowns, and 10% is an economic depression, said the founder of hedge fund Hayman Capital Management in an interview. Indeed, the last time the U.S. economy contracted on an annual basis was during the financial crisis in 2009, when it shrank by 2.5%. The last time it shrank by more than 10% was in 1946 at the end of World War II. Prior to that, the U.S. economy shrank by 12.9% in 1932 at the height of the Great Depression. So we talked a little bit about that already. We talked about the 2008 housing market collapse that led to the 2009 financial crisis. He's predicting that we're going to see an economic contraction that could be more than 3 times as severe as that suffered during the Great Financial Crisis. So for those of you that are old enough to remember the housing market collapse, it was a big deal. A lot of people lost a lot of money. A lot of people lost their jobs. A lot of people lost their lives. Many people in the financial sector actually ended up committing suicide because it was such a big deal to them. They didn't think that something like the housing market could ever collapse. They laughed at people like Kyle Bass. And then eventually it did, and they hadn't prepared. None of them had prepared for something like this. So it's a big deal what he's saying. He's saying that this financial crisis that we're currently in could be 3 times as severe as what occurred during the 2009 Great Financial Crisis. That was the biggest decline in our economy that I've ever seen in my lifetime. And it was a big deal. It taught me a lot about what could happen with our economy. It taught me the value of the dollar. A lot of people today will never get to experience something like that, or at least they wouldn't have until now with this pandemic that's hit us. So I'm definitely going to heed his warning that this is looking really bad, but let's talk about why it's looking bad. One of the things that I talked about earlier is that the Federal Reserve is responsible for printing money here in the United States. And something that they've done since the beginning of this crisis, this pandemic, is print a substantial amount of money. Where did I see? I saw an actual number. All right. So the Federal Reserve has printed $6.7 trillion since mid-March. Now, March was only 2 months ago. So this was exactly 2 months ago they started printing money. And since that time, they've printed $6.7 trillion. That number should not be taken lightly by any means, because we're not talking about millions, we're not talking about billions, we're talking about trillions of dollars that have been printed in just the past 2 months. Now, what do you think that's going to do to the value of the US dollar if we just have 6.7 trillion of them minted into existence out of thin air? What do you guys think is going to happen to the US dollar? We're definitely going to have hyperinflation. But what else? What else could happen with $6.7 trillion being printed into existence? Our national debt is going to go up. And if you take a look at our debt clock, and take a look at our GDP, our GDP currently sits at about $21 trillion annually. So every year, the US will generate about $21.3 trillion in gross domestic product. Right now, our national debt is sitting at about $25 trillion. By printing money in the Federal Reserve and loaning that out, that's creating more national debt for the United States. And if you look at the US federal debt to GDP ratio, in 1960 it was pretty high at 52.9%. 1980 it went down to 34. In 2000 it was at about 58%. And now we're sitting at roughly 117.9%, so about 118% debt to GDP ratio. Our debt is now above our GDP. We have crossed that line of spending more than we're taking in. And a lot of people will count this out as, just conjecture that number doesn't really matter at this point in our economy, but it really does. Somebody is eventually going to have to pay for this debt that the US government has initiated. And it might not be in the current White House time. Like, the president and all of his advisors might not see the ramifications for building up this debt, but I might see it in my lifetime. My children might see it in their lifetime. This matters. We have to take a look at these things. I was reading an article earlier about, can we print infinite money to pause the economy during the coronavirus pandemic? What happens if we printed enough money to make sure everyone keeps their jobs? Right now, the unemployment rate is sitting at about 13%, which is higher than we've seen ever. That's higher than the Great Depression. Many people know the Great Depression as the highest unemployment rate the U.S. has ever seen. Well, we're higher than that now during this COVID-19 crisis. Another thing that we're seeing from the Federal Reserve is something that we've never seen before, and that is them propping up the stock market, like I talked about a little bit earlier. The stock market should definitely be moving in a downtrend, but yet we're seeing stocks just go up and up. So what's the deal with that? The Federal Reserve has decided to prop up the stock market by putting some of the money that they've printed out of thin air into our market. Essentially buying up stocks that other people aren't to keep businesses afloat, which you can say from, a different perspective that that's a good thing. But in the long run, that's actually a terrible thing, because what happens once the Federal Reserve runs out of money to prop up the stock market? Are they just going to print more money? And then what happens whenever they print more money? Is that going to inflate the US dollar even more? I think so. I definitely think that by printing more and more money and propping up the stock market with this fake money that was just printed, it's going to inflate the US dollar. And if we can't buy things with the US dollar because everything is too expensive because of inflation that has been caused by the printing of more and more money, then what do we do at that point? Well, there are several things that you can do, and that's what I wanted to talk about. Let's go to this. So, to prepare for this economic crisis that we're about to see, there are several things that you can do to hedge against the economy. Now, a lot of people have made claims that the stock market is no longer tied to the economy, but I completely disagree. If you look, the only reason our stock market is doing good is because that fake appearance of the Federal Reserve printing money to throw into the stock market. Before that money was printed, it was nowhere. So it literally printed that money out of thin air just to prop up our stock market and make sure that it doesn't fail. It's fake money. It's not real. And it's inflating our US dollar. So there are several things that you can use to hedge against the US dollar, and I think that's the wisest thing you can do at this point. One is obviously gold and precious metals. So gold, silver, aluminum, platinum, things like that. Those are going to be valuable no matter what because we will always need those. Gold can be used for many different things, but one thing that gold will always be used for is money. Gold will always be a form of money in this world. Ever since we found it, it's been a form of money, and it's been a tradable asset. So I don't foresee that ever going away. So I'm going to tell you guys that gold and precious metals are definitely one way that you can hedge against this market. The next thing that you can use to hedge against this market is obviously Bitcoin. And I don't want to throw cryptocurrencies as a whole at you guys, because I don't foresee all of the cryptocurrencies that are currently on the cryptocurrency market succeed. I think a lot of them are going to fail. And if you look throughout the history of cryptocurrencies, that statement is highly accurate. If you go on CoinMarketCap and look at all of the cryptocurrencies that are still in existence today as opposed to 5 or 6 years ago, you might be very surprised to see that there are a lot of cryptocurrencies that were in the top 10 that are no longer there or anywhere because they're no longer in existence on our market. A lot of those cryptocurrencies aren't even traded on any online exchanges. So the reason that I say Bitcoin is because I think that Bitcoin has the safest bet of succeeding even in a market downturn. Bitcoin is the first mover in the market for all blockchain technology. It is world known, so people around the globe know exactly what Bitcoin is and what it does. It has the most network support in the world. It has the highest security in any blockchain that I know of. And it can be traded with anyone, anywhere. And I think that's why Bitcoin is going to succeed. And I think it's a great hedge against the current market. The last thing that I think is going to be something that you can use to hedge against the market is something that I actually talked about earlier, and that is real estate. So I said that the value of real estate just continues to go up even though it shouldn't. And I still stand by that. But I think that even if the value of real estate goes down during this economic crisis, that it will eventually go back up. These valuations of real estate, they always tend to go back up over time. And so if you purchase in a good spot that you know is going to be valuable over time, especially like up and coming locations that have tons of construction going on to build shopping centers, things like that, I think that real estate would be a good purchase to hedge against the current market. So those are my three picks that I'm going to use to hedge against this economic collapse that I foresee coming. Bitcoin is obviously going to be my number one hedge against the market, but I will also be making purchases in precious metals and in real estate. The home that I currently am in is obviously one of the purchases that I've made in the real estate market. However, I plan to eventually expand and buy up some rental properties that I can use to continue making profits over time, and eventually maybe even sell those properties for a profit. We'll see what happens with that. But Bitcoin just is the safest bet as far as I'm concerned. With gold, you have to worry about moving it, you have to worry about storing it. And you could say the same thing about Bitcoin. You have to worry about storing that as well. But a hardware wallet like the Ledger Nano S is incredibly easy to keep track of and store. So that makes it a lot easier in my eyes than hoarding gold. But like I said, gold is still another asset that I think would be a good hedge against the coming market collapse. And there's a lot of things that I didn't get to cover tonight just due to time constraints, and there's a lot of things that I would have to do a lot more research on to discuss with you guys, but those are the main points that I wanted to talk about. So what we covered tonight were the value of the US dollar collapsing, the 2008 housing market collapse, along with the Great Depression and the similarities between that and now. We talked about the Federal Reserve and its responsibilities in this time, what it does and why it is going to cause this eventual collapse. We talked about the US GDP and the national debt. We talked about the unemployment rates, and we talked about inflation. We also talked about Kyle Bass and what he sees coming with this economic collapse as well. So we discussed all those things and what I think are hedges against the market moving forward. If you own stocks or you own any type of mutual fund asset like that, then I would tell you that now is probably a good time to get out of the market while the Federal Reserve is boosting the market. I don't foresee it being able to last. There's no way that the Federal Reserve could continue to print money just infinitely and continue to prop up the stock market while people are trying to save as much money as possible. All of these people that have lost their jobs moving forward are not going to be going out and making purchases, large purchases or things like that to boost our economy. It's just not going to happen. Somebody without a job isn't going to go out and make a bunch of purchases. And that's exactly what boosts our economy. So what do I think is going to happen? I think eventually the Federal Reserve is going to run out of money to print due to hyperinflation. And I think the stock market is going to fall out. I think that we're going to see a dramatic downturn in the market that we haven't seen before, at least in my lifetime. Because like I said, the Federal Reserve can only print so much before the dollar is worthless. And I don't know at what point that will be. I don't know when the inflation will catch up and the market will see just how worthless the US dollar is, but it is going to eventually happen. We're definitely going to see the US dollar not be able to purchase a piece of gum. It's going to happen in our lifetime. And I hate to say that because I live here in the US and I don't want to see my country fail. I don't want to see the economy fail and people lose their jobs and their lives. But it definitely looks that way to me. I can't foresee any way that the US dollar could magically go up in value, especially after we just printed $6.7 trillion out of thin air. There's just no way. Like I said earlier, what's going to happen once the Federal Reserve is no longer boosting our stock market and people don't have money to buy stocks? What happens then? Do you think billionaires and millionaires are going to step in and say, hey, we got this. We're going to buy all of these stocks up to boost the economy? I don't foresee that happening. Another thing that I wanted to talk about that I forgot about was actually buybacks. Guys, please do your research on buybacks over the past 20 years. Not 20 years, 11 years. Let's say 11 years. Look and see all of the companies, all of the corporations that got federal loans to be bailed out after the 2009 financial crisis. Look and see what they did with their money. Definitely read up on buybacks, because if you look and see all of the profits over the past 11 years from some of the largest corporations in the world, you might see that a lot of those profits have come from buybacks. Well, what does that mean exactly? That means that the profits that we are seeing are not necessarily real. Buybacks are essentially when the company goes in and purchases a bunch of their own stocks. And you might say, well, they did really well and they could afford to buy up some of their own stocks. And I would completely disagree with you. It's basically a way of propping up their own business. And I don't think it's ethical to do that. But that's a completely different topic that we would have to, that would take too much time to cover. Those are the things that I wanted to talk about today, guys. That is why I think that the market is about to head towards a very, very sharp downturn. Thank you guys so much for watching, and if you haven't already subscribed to the channel, I will be bringing as much content as I possibly can to you guys over the next few weeks, few months that pertain to the market and what I foresee happening. And, you know, I'm just one guy that is doing research on these types of things. If you would like to add your input, please leave some comments in these videos that pertain to this. I would love to hear your feedback. Thanks again for watching, guys. That's going to be it for today. Crypto Clay out.